Hi everyone, welcome back to Consolidation chapter. Today in this video we are going to solve this illustration 3 of the ICAI study material, and this question mainly focuses on the revaluation and dividend adjustment. But of course this is a simple straightforward problem, so there is not much to understand regarding the revaluation adjustment in this question. Okay, it's a very straightforward problem. Just by solving this question you will not understand practically how to do the revaluation. No, you need another question for that, because here it's very straightforward. You will see when we'll analyze the question. Okay, and then regarding dividend, of course we have to identify and we'll see how you have to treat that. Fine, so let's read the question. See here, XA Limited acquires 70% of equity shares of Z Limited. So XA Limited is the holding company which has acquired 70% stake in the Z Limited, which is the subsidiary company, on 31st March 2021. Now this is the date of acquisition. Now see properly, this is the last date of the year, isn't it? 31st March 2021. So in this question, date of acquisition is equal to the date of consolidation. Date of acquisition is equal to the date of consolidation, and always keep this in your mind. Whenever date of acquisition is equal to date of consolidation, that means there will be entire time adjustment. There will be entire time adjustment. All the 12 months in the current year would be pre-acquisition period. Yeah, and in a full-fledged question, when you will apply the time adjustment, you will apply the time adjustment of the whole 12 months. All the post profit will be transferred into the pre-column. Is that clear? That's what will happen. But here, of course, this is not a full-fledged question. Here we are not doing AOP and all, so just forget about that. But to build your base, to build your concept, I told you that whenever date of acquisition is equal to date of consolidation, entire 12-month adjustment would be there. Okay, and the entire period, current year period, would be pre-acquisition period, because you have acquired at the last date. So the entire current year would be pre-acquisition period. Fine. Okay, then they are saying at a cost of 70 lakh. So this is the cost of investment. Fine. The following information is available from the balance sheet of Z Limited, balance sheet of subsidiary, as on 31st March 2021. See, what do we have in the balance sheet? See here, this detail will not be available mostly in the full-fledged question. That is why this is a very simple and straightforward question, because the question is telling you exactly what is there in the balance sheet on the date of acquisition. Yeah, at the last date in the balance sheet what you have, and that's the date of acquisition, right? So the details of asset and liabilities is available on the date of acquisition, which will never happen mostly in the full-fledged question. Okay, that's why it's a straightforward problem. See here, property, plant and equipment 120 lakhs. All the figures are in lakhs. Okay, investment 55 lakh, current assets 70 lakhs, loans and advances 15 lakh, 15% debentures 90 lakh, current liabilities 50 lakh. You see this? Here you are given the details of assets and liabilities on the date of acquisition. You have not been given the details regarding equity portion of the balance sheet, equity share capital, reserves and surplus. Yeah, that thing is not given. So if that thing is not given, you cannot do analysis of profit. You all know that you cannot do analysis of profit. So how will you calculate the net assets on the date of acquisition? See here what they have asked. What's the requirement in this question? Let's see that. See the requirement. Calculate the amount of goodwill or capital reserve on acquisition of shares of Z Limited. How do you calculate goodwill or capital reserve? In which working note? Working note number 2. Cost of investment minus pre-acquisition net asset. That's what you do, right? Cost of investment minus the net assets of subsidiary that is owned by the holding company on the date of acquisition. That's what you do. And you calculate goodwill or capital reserve. It's positive amount, then that's goodwill. If the resultant figure is negative amount, then that's capital reserve. But here, how will you calculate net assets on the date of acquisition? To do the working note number 2, how will you calculate? You will use the asset minus liabilities approach, because in the question asset and liabilities on the date of acquisition is given. Is that clear? So it's a simple and straightforward question. Fine. But you all know that in cost of control we take what? Market value of the net asset. Yeah, the revalued amount of the net assets, isn't it? So here in this question they have said, see here, the following revaluations have been agreed upon. When this revaluation is happening? At the last day of the year. Yeah, I mean revaluation happens in consolidation. Revaluation happens on the date of acquisition. On the date of acquisition, but the date of acquisition is equal to date of consolidation. So revaluation is happening at the end of the year, right? If it's happening at the end of the year, then there is no question of additional depreciation and saving in depreciation. Again, a very simple and straightforward problem. You see this? Additional depreciation and saving in depreciation, that question, yeah, that concept will not apply over here, because see here, revaluation happened the same day you are preparing consolidated financial statement. So there is no additional depreciation or saving in depreciation. Is that clear? So what has happened, see here, property, plant and equipment has revalued upwards by 20% from 120. See here, PPE was 120 in the books, right? Book value. It has been increased by 20%. So how will you increase by 20%? Just multiply by 1.2. Yeah, 120%. So if you just multiply, it's 144 lakh. And then investments are down by 10%. So investment value is how much? 55, right? So just take 90% of that. You have, revalued it downwards by 10%. So into 0.9, 90%. So that's equal to 49 lakh point 50,000. Is that clear? That's all. So you will just adjust these in that calculation, asset minus liabilities calculation. You will just take these figures and automatically you will have, after doing asset minus liabilities, you will have net assets, revalued net assets on the date of acquisition, the entire amount, and then you will take the holding share in the working note number 2, cost of control. Is that clear? Right. So that was regarding the revaluation part. Now here in this para they have said, see here, Z Limited declared and paid dividend at 20% on its equity shares as on 31st March 2021. Face value rupees 10 per share. Exi Limited purchased the shares of Z Limited at rupees 20 per share. Now this is regarding that cost of the investment. Yeah, the cost of the investment was 70 lakhs. They purchased the shares of the subsidiary at this much cost per share, rupees 20. So that will help us to calculate the total capital, okay, because of the dividend calculation. You'll see that. Let's just see the solution and let's understand how this will be done over there. Now see here, we have the solution. First, let's understand the timeline of this question. So what happened was, see here, Exi Limited holding company acquired 70% stake in Z Limited at the cost of 70 lakhs. Isn't it? Yes. And this acquisition happened on 31st March 2021, the closing date of the year. Right? So if it's happening on the closing date of the year, that means date of acquisition is equal to date of consolidation. So when that is equal, date of acquisition is equal to date of consolidation, then the entire current year period would be pre-acquisition period. Simple, now just think. You Exi Limited, think from the point of view of holding company. You have come and acquired the subsidiary company on the last date. So here only you will prepare the consolidated financial statements. Then when you will see the current year, yeah, for which you are preparing the financial statements, that entire current year period would be the period when holding company did not have the control. So that entire period would be pre-acquisition period. Is that clear? Isn't it? Yes. So whatever profits that will be there in the company, in the Z Limited, all that profit would be pre-acquisition profit. Isn't it? See here, you came and you acquired the company on the last date, and on that same day you are preparing consolidated financial statement. So whatever trading and whatever things have happened in the company, it has happened previously to this. So all the profit that has been generated in the Z Limited, that entire profit would be pre-acquisition profit. Is that clear? I mean, whatever profit was there, that is completely pre-acquisition profit on 1st April, profit and loss balance. And then whatever has been earned in this period, that will also be pre-acquisition profit. There is no post-acquisition profit over here. Is that clear? So this entire dividend which is given out over here on the last day, this would be pre-acquisition dividend. Is that clear? This would be pre-acquisition dividend. Now we'll come to that. Don't worry. Yeah. Let's just read that dividend thing again. See here. Z Limited declared and paid dividend at 20% on its equity shares as on 31st March 2021. What they are saying? They are saying that Z Limited, subsidiary company, declared and paid the dividend. And how much is that? 20% on the equity share capital, which was outstanding in the books on 31st March 2021, the closing date of the year. Now, in the whole question, the capital information is not there in the whole question. So what we have to do? We have to calculate what is the capital, equity share capital that was outstanding in the subsidiaries books on this date. How will we do that? It's simple. We have this information, 70% stake we have acquired, holding company, and the cost was 70 lakh. And also in the question they have said that the cost per share of the the cost per share for us, for the holding company, was rupees 20 they have said. Okay, rupees 20, and the face value also they have said, face value of the shares is rupees 10. So from this detail we can calculate what was the total capital outstanding over here. How will we do that? See, it's very simple. First we will calculate number of shares purchased. Yeah, number of shares we have purchased, holding company has purchased. So how will we do that? We will take the cost of investment, which is 70 lakhs, divided by the cost per share, which is 20 rupees. Okay, which is 20 rupees. So when we divide that, we will get total number of shares, which is 3.5 lakh shares. Okay, 3.5 lakh shares. Now this 3.5 lakh share is how much? This is only 70% stake, because we have acquired 70% stake. Now we took 70 lakhs divided by cost per share, we got 3.5 lakhs number of shares, but this is only 70% stake. This is only 70% stake. So what we have to do? We have to gross this to 100%. See here, how will we do that? It's very simple. What are you going to do is, you are going to take that 3.5 lakh shares, this is 70%, this is at 70%, so divided by 70 you will get what is 1%, and if you multiply by 100 you will get what is 100%, the total number of shares, which is 5 lakh number of shares, 5 lakh. And the face value the question told you, the face value the question told you is rupees 10. So what you will do, just multiply by rupees 10, you will get 50 lakhs. 50 means 50 lakhs in this question, yeah, because all the figures are like that. So 50 lakhs is the total equity share capital which was outstanding at the end of the year. Yeah, see the whole calculation over here, it's very simple. This is at 70% stake, gross it to 100%, 3.5 lakh divided by 70, multiply by 100 to make it 100%, 5 lakh shares, number of shares, and then to calculate the whole capital, equity share capital, 5 lakh shares into face value rupees 10, that is 50 lakhs. Is that okay? Easy? Yes. Now let's come back to the dividend. How the dividend is pre-acquisition? See, it's very simple. You came and acquired the company over here at the last day, and then the Z Limited declared and paid the dividend. So obviously the dividend source is pre-acquisition profit, because there is no post-acquisition profit in this question. Yeah, why? Because see, this entire period is pre only, and whatever that was there on the 1st April, that is also pre. So where is post-acquisition? There is no post-acquisition profit. So the source of the profit has to be pre-acquisition profit. Is that clear? So see here, given on the last day of the year and on the date of acquisition, therefore the source of the dividend has to be pre-acquisition profit, and so that's why this dividend would be called as pre-acquisition dividend. How much is that? It's simple, 20% on the equity share capital as on the last day of the year. So we calculate that is 50 lakhs. Yeah, we calculated that. So 20% on 50 lakhs. Yeah, see here, 50 lakhs into 0.20, that's equal to 10 lakhs. 10 lakh is the dividend, and this dividend is entirely pre-acquisition dividend. Now what will happen to this dividend? Who has issued this dividend? The Z Limited, the subsidiary company. Who are the owners of subsidiary company? Who will get the dividend? XA Limited is the owner and the minority interest. XA Limited is 70% owner and 30% is minority interest. So 30% will go to minority, which is 3 lakh, and 70% of 10 lakh, that is 7 lakh, which will go to the holding company. Now what holding company has to do with this 7 lakhs? We are not concerned about minority interest. Just forget about the minority interest. They have got the dividend, they did the accounting in their own books. We are not doing that. Yeah, we are not concerned about minority interest. We are only concerned about the holding company. You all know, according to ES 13, this is pre-acquisition dividend. So what holding company has to do? Holding company has to consider it as recovery of cost, because see, when they purchase the shares of Z Limited, in that cost of investment, in that 70 lakhs, the dividend element was already included. Yeah, that is why what you have to do according to AS 13, you have to deduct that 7 lakhs, from the cost of investment, So 70 lakhs minus the dividend 7 lakhs, that is equal to 63 lakhs. Is that clear? That's what you will do. Fine. So this was the whole treatment of regarding the dividend. Now we have to see the cost of control, because that's the requirement of this question. This was not the requirement actually. The requirement was, see here, calculate the amount of goodwill or capital reserve on acquisition of shares of Z Limited. So now let's see what you have to do, in the cost of control. How will you do that? So see, it's very simple. In cost of control, what do you need? In cost of control, you all know that you need, you need cost of investment, and you need net assets of subsidiary that is owned by the parent on the date of acquisition. When you subtract these two, if you get a, the positive figure, that means it's goodwill. If you get a negative figure, then that's capital reserve. Yeah, but in this question, see here, we had to calculate net assets of subsidiary owned by the parent, yeah, through asset minus liability approach, because nothing regarding equity is given in this question, so we cannot use AOP approach. Yeah, we cannot use the equity approach. We have to use the asset minus liability approach. So it's very simple. I told you it's very simple. Yeah, see here, what you will do, you will just take all these things from the questions here. Property, plant and equipment 144 lakh, the revalued amount you will take 120 lakhs into 120%. Yeah, the revalued amount. Investment 55 lakhs into 90%. Is that clear? You will not take these figures 120 or 155. No, you will take the revalued amounts. Okay, you will take that. Current asset, loans and advances as it was there in the question. The total assets are 278.5. okay, 278 lakh point 50,000, and you will subtract the liabilities, 15% debentures, current liabilities, you will subtract that. Yeah, assets minus liabilities, you will get net asset, which is 138 lakh 50,000. okay, 1 crore 38 lakh 50,000. That's the net assets of subsidiary on the date of acquisition. But in cost of control, what do you take? Net asset of subsidiary owned by the holding company only. So of this 138.5, you will only take 70%, 0.70. That's equal to 96 lakh 95,000. Yes, that's the holding share. Yeah, and then you will do the cost of control. Now to do the cost of control, it's very simple. You all know, you will take cost of investment 70 lakhs. Now this 70 lakhs in full-fledged question, where you will get this? From the balance sheet. Okay, in the balance sheet it will be there. Investment in subsidiary, in the holding balance sheet will be there. 70 lakhs. You will take it from there. And then you will subtract pre-acquisition dividend 7 lakh. Pre-acquisition dividend 7 lakh you will subtract. Okay. Pre-acquisition dividend, yeah, we saw that, right? See here, pre-acquisition dividend is how much? 7 lakh, which is a recovery of cost. You have to deduct it from the cost of investment, the holding company. So that's what holding company is doing. The net cost of investment is 63 lakh. Now from this 63 lakh, you will subtract what? Net asset of subsidiary owned by the holding on date of acquisition, 96 lakh 95,000. Yes. Now mostly what used to happen, we used to get this from the AOP, yeah, statement of net assets, analysis of net asset, or AOP. From there you used to get this. But here in this question, you could not do AOP because of lack of information. You had to do this to calculate. This is a very simple way actually. AOP is a little bit complicated. Fine. So you subtracted this and you get a negative amount. See here, let's just do all the calculation here. 70 minus 7, yeah, 70 minus 7, that's equal to 63, and then you have 63 minus then 96.95, then you get this 33.95, yeah, 33 lakh 95,000. Now this is what? See here, negative amount. So that means this is capital reserve. Yeah, you are gaining over here. You have paid 63 lakh net, and you have got net assets, more net assets. So that means you are gaining by 33.95, which is capital reserve. Is that okay? So this is all regarding this question. Fine. So it's not a big deal. It was a very simple question. I just wanted to make you understand regarding the dividend. Dividend which you are getting at the end. This is the date of acquisition and the date of consolidation. There is no post-acquisition period. There is no post-acquisition profit. Entire, profit is only pre. So of course the dividend must have come out from the pre-acquisition profits. Okay, so pre-acquisition dividend, and yeah, recovery of cost, you have to deduct it from the cost of investment. But of course in full-fledged questions you have to consider many things, whether the question is silent regarding the the treatment, what has happened, whether the correct treatment has happened, that thing you have to see in full-fledged question. But this was just a simple straightforward question, nothing was there over here. That is why we will not consider all the options. But mostly in the silent question, you will always consider that error has happened regarding the pre-acquisition dividend. Error has happened, and you will do this treatment in CFS, which is, subtracting from the cost of investment, pre-acquisition dividend, and also subtracting from the consolidated profit and loss. Working note number 2 and working note number 4. Yeah, this is what you will do in this silent question, bestseller in exam, I've told you, in the dividend adjustment. But if the question specifically tells you that correct treatment has been done regarding the pre-acquisition dividend, correct treatment has been done, then you will not do anything. Okay, you will just ignore that. You will not touch any working notes. That means you will not touch the working note number 2 and working note number 4 regarding the pre-acquisition. But sometime what can happen, understand, sometime a dividend will be given to you, but of that dividend they might have done an error, but only the pre-acquisition dividend you have to rectify. Yeah, the entire dividend they will take it to profit and loss, the holding company, in separate financial statement. Okay, so what will happen, let's say 10,000 dividend is there, 7,000, let's say 10,000 entire share, okay, 10,000 share of holding company in the dividend. Okay, so now let's say out of that 10,000, 7,000 is pre and 3,000 is post. So what the holding company did, they took entire 10,000 to the profit and loss. Yeah, to the profit and loss. So what you will do now, you will have to rectify only the pre-acquisition dividend. The remaining post-acquisition which went to the profit and loss, that is correct treatment. You will not touch that. You will only rectify 7,000 dividend. Pre-acquisition dividend you will rectify. 7,000 less from working note number 2, 7,000 less from working note number 4. That remaining 3,000 you will not touch that. Okay, that is completely correct treatment has been done regarding that. So that 3,000 you will ignore. Only the pre-acquisition you will rectify if in case something like that happens. Okay, 10,000 dividend has been received by the holding company I'm talking about, not the entire dividend. Entire dividend is something else. Let's say it's 15,000. I'm not talking about the entire dividend. Okay, entire dividend will be dealt in AOP. That's different. Only the holding share I'm talking about. Only the holding share will affect the working note number 2 and working note number 4. Is that clear? So that's it for this video. I have clarified each and everything. Fine. So see you in the next question. Bye.